This detailed report provides an in-depth analysis of the stock market's reaction to the hotter-than-expected July wholesale inflation data, focusing on the Dow Jones Industrial Average and its broader implications for the economy. Executive Summary. On Thursday, August 14, 2025, the Dow Jones Industrial Average dropped over 100 points in early trading, a direct response to the release of the Producer Price Index (PPI) report for July. The data revealed a significant and unexpected surge in wholesale prices, which sent a ripple of concern through the financial markets. This hotter-than-expected inflation reading has cast a shadow over recent market optimism, which was fueled by a softer-than-anticipated consumer inflation report earlier in the week. The core concern for investors is that persistent inflationary pressures could force the Federal Reserve to maintain a tighter monetary policy for longer, potentially delaying or even preventing the interest rate cuts that the market had been eagerly anticipating. The Producer Price Index (PPI) report, a deep dive into the data. The U.S. Bureau of Labor Statistics reported that the Producer Price Index for final demand rose by a startling 0.9% in July, well above the 0.2% increase that economists had forecasted. This was the largest monthly increase in wholesale prices in over 3 years, since June 2022. On a year-over-year basis, the PPI jumped to 3.3%, a significant acceleration from the 2.3% recorded in June and a 5-month high. Crucially, the report showed broad-based inflationary pressures. The index for final demand goods increased by 0.7%, driven by higher prices for food products like vegetables and metals, many of which are heavily imported. Even more concerning was the 1.1% increase in the cost of services, which has been a major driver of inflation in recent years. The core PPI, which strips out volatile food and energy prices to provide a more stable measure of underlying inflation, also came in much hotter than expected, rising 0.6%, the biggest increase in 3.5 years. This indicates that the inflationary problem is not confined to a few volatile sectors, but is deeply entrenched in the economy. Market reaction and investor sentiment. The stock market's immediate reaction was a sharp reversal of the positive momentum it had built up over the preceding days. The Dow Jones, which had been nearing a new record high after a rally earlier in the week, gave up its gains. Other major indices, including the S&P 500 and the Nasdaq Composite, also pulled back from their own record highs. This market movement is a classic risk-off response, as investors move away from riskier assets like stocks in the face of economic uncertainty. The primary driver of this shift in sentiment is the reassessment of the Federal Reserve's likely course of action. After a weaker-than-expected jobs report in late July and a more benign Consumer Price Index (CPI) report earlier this week, the market had become increasingly confident that the Fed would begin cutting interest rates in September. The hot PPI data, however, has thrown this narrative into question. The Federal Reserve's dilemma. The Federal Reserve's dual mandate is to maintain maximum employment and stable prices. The PPI report complicates this task significantly. On one hand, the labor market has shown signs of softening, which would typically give the Fed room to ease monetary policy. On the other hand, the persistent and broad-based inflation shown in the wholesale price data suggests that the battle against rising prices is far from over. The Fed is now walking a tightrope. If they cut rates too soon, they risk reigniting inflation, which could lead to a more severe and prolonged economic downturn. If they hold off on cutting rates for too long, they could stifle economic growth and potentially trigger a recession. The hotter-than-expected PPI report makes the case for holding off on rate cuts much stronger, and while some market participants are still holding out hope for a September cut, the likelihood of a third rate cut later in the year has diminished considerably. Why wholesale inflation matters for the Dow. The Producer Price Index is a crucial leading indicator of future inflation. It measures the prices that businesses pay for goods and services, and these costs are often passed on to consumers in the form of higher retail prices. As such, a surge in wholesale prices today can be a strong predictor of a future rise in the Consumer Price Index, CPI. For the companies that make up the Dow Jones Industrial Average, higher wholesale prices can have a direct impact on their bottom line. Increased costs for raw materials, labor, and transportation can squeeze profit margins, leading to lower earnings. In an environment of high inflation and high interest rates, consumer spending may also decline, further hurting corporate profits. This double whammy of higher costs and lower demand is a significant headwind for the stock market, and it explains why investors reacted so negatively to the PPI report. The broader...
Thank you.
Like, comment and subscribe.